Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current sessions pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC. We move down. Here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BB-KPL, QL below BB-KPL, the first midpoint above the BB-KPL, and the first midpoint level below the BB-KPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BB-KPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BB-KPL on that bullish trade triggered from the BB-KPL level, and your standard stop loss is the first midpoint below, which would be mid BB-KPL S1 for a bullish trade taken off of the BB-KPL level. Conversely, on a bearish trade taken from the BB-KPL level, your tight stop loss is the QL above the BB-KPL, and your standard stop loss for a bearish trade taken off of this BB-KPL level is the first midpoint above the BB-KPL, which is mid BB-KPL R1. The same principle applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1, R2, mid R2, R3, mid S1, S2, and mid S2, S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1 and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is to QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1. And you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1, because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BB-KPL R1, because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say the price goes up to R2, now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BB-KPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint but above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3, because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking the bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BB-KPL, your standard stop loss is the mid BB-KPL R1, because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the BB-KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BB-KPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the BB-KPL, so your standard stop loss is the first midpoint level below the level in question, the BB-KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BB-KPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a cross below, close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First For a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BB-KPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, so now we're going to take a look at another session, the SPX CBOE Friday, January 9th, 2026 session. The purpose of this is going to be looking at taking trades off of other levels as well and waiting throughout the session for price to hit a level that you prefer to take trades off of rather than taking trades right from the start of the session. So here we have the opening candle which closes below the BB-KPL. This is the 9:30 a.m. opening candle here for this session, and is still within the acceptable range. So the acceptable range for the opening candle, and also acceptable range for candles in general taking trades off of any of the main key levels, is discussed in another video. There's also an accompanying PDF document on that particular topic. So keep in mind this note here. If starting with the 9:30 a.m. opening candle in this particular session, if you were starting your trades with the 9:30 a.m. opening candle, this resulted in one loss on the opening trade, which was this bearish trade here, and then there were two winning trades after that. However, please keep in mind that with this indicator, you don't have to follow using the 9:30 a.m. opening candle strategy, nor do you have to take trades early on in the session. And you can instead just wait for your first trade to enter by waiting for price action to hit a specific R key level or S key level before entering a trade, such as the case in this particular session when price eventually was stretched to the downside and hit and bounced off of the S2 level and gave a bullish entry. That bullish entry off of S2, as an example, could have just been your trade number one of this session instead of starting to take trades right off the 9:30 open. So keep in mind that if we were starting the session here, these are the trades that would be followed afterwards if we were starting off with this trade and then we had this loss on getting stopped out here on the standard stop loss on this trade. And then we have our re-entry here, which was a winning trade, and then we have the bounce off of S2 here. As you can see where this candle touched, we had the long wick down below here. This isn't exactly a true hammer candle here, but it is somewhat similar to one. And mainly the most important point is here you have this wick bouncing off of S2, and then you have this candle here afterwards reconfirming this bounce. So the point is that you don't have to start off taking the 9:30 a.m. candle trade, although you see in a lot of our videos that is our preference as far as using the daily key level strategy, is to start off with the 9:30 a.m. opening candle trade. However, that doesn't mean that everyone else has to do that as well. With this particular indicator, you can simply wait for the session to play out more and pick and choose which of the main key levels. Again, the main key levels are the bull bear key price level, your R1 through R6 levels and your S1 through S6 levels. Those are the main key levels that you can take trades from, because the QL levels and the midpoint levels have other purposes. The QL levels, again, being tight stop losses on trades, whether you're taking a trade above and below a particular level. Those QL levels can be turned on above or below any of the main key levels. And then you also have the midpoint levels above and below each of the main key levels, which can be turned on or off in your user control panel. And those are used as the standard stop losses, as you can see here. So for example, starting off with this session here, you could have, instead of starting off with the 9:30 a.m. candle trade, or with your strategy in general, you can simply wait for the opening range to play out, whether you want the opening range to be, say, the first 5 minutes, the first 10 minutes, 15 minutes, 30 minutes, or an hour, before deciding what exactly you would like to do once price has reached a particular key level that you want to take a bullish or bearish trade off of. Or you can simply not wait for a specific set period of time to pass, such as the opening range, but instead just wait and be patient throughout the session for price to see if price eventually gets stretched in one direction or the other to either the upside or the downside, and then take a reversal trade, such as in the case of this particular situation here, where we had this price being stretched to the downside. We had this touch and bounce off of S2 with this confirmation candle afterwards, and simply this could have been our trade number one of the day and could be the only trade of the day taking this trade. And then your standard stop loss is here for the S2 level bull trade. And then if you wanted to use the tight stop loss, then you could use the QL below S2. Now typically we prefer to use the standard stop losses. However, if your preference is to use the tight stop losses, then that is fine as well. You just have to know that the tight stop losses are more prone to getting stopped out. However, in clean moves, neither one is going to get stopped out, such as in the case here, as you see here. So it really just depends on what you feel more comfortable with using on a repetitive basis, either the tight stop loss or the standard stop loss. And in this particular session later on, price continued to move up and even went up to R2 eventually later on in the session, and then also went up beyond that, which I can show you now. So as you can see here, this bounce off of S2, eventually it did go up to R2. So if you were still holding some runners, if you were trading multiple contracts and you wanted to see, instead of getting out at the 1.5 level move or 2 level move, to see if any runners could extract some more profit, then you eventually had a move up to R2, and then eventually here at the end of the day, you can see it goes up and just touches mid R2, R3 before trailing off for the end of the session. So this occurred here, this touch here around 322, 324, as you can see, a perfect touch of that, and then a move back down to R2. So the additional point here is that in our welcome letter that we send out to people who have purchased the SPX Daily Key Levels Indicator, is that when you first start using the indicator, it's usually a good idea, and it doesn't really matter whether it's the hour indicator, this Daily Key Levels Indicator, or even if you've purchased an indicator, a different indicator from another company, or whether you are even using a free indicator or an open source indicator. When you're using a new indicator, it's usually a good idea to practice with it for a significant amount of time before, on a demo account, such as a Thinkorswim demo account where they actually offer real-time quotes and fills on their demo account, whereas a lot of demo accounts with other companies have either delayed uh, quotes or they don't have realistic fills where you can actually have a practice sessions that are actually meaningful. You have to actually have real-time data and realistic fills in order for any practice trading on demo accounts to actually account for anything. So you know that that would pretty much mirror what would happen in real time on a regular account. So the point being that typically, say, practice for 25 to 35 sessions. Of course, if you're a more experienced trader and have a lot more experience in the market, you know, that would be probably less sessions than that. And if you have virtually no experience, you might need more sessions than that. The point being is that you need that many sessions or somewhere within that vicinity to get used to trading with the indicator in over 25 to 35 sessions, which that's basically 5 to 7 weeks, or you can look at it as 4 to 6 weeks or so of sessions. You're going to see a wide variety of different market scenarios and a wide variety of different types of sessions. You're going to experience winning trades and losing trades, and you're going to go through the process of figuring out whether you like to take the 9:30 a.m. opening candle trades, whether you like to take trades during the opening uh, earlier part of the morning session, or do you prefer to wait until price actually hits, say, the S2 level on any given session to take a trade, or hit the R2 level, or hit any of the other main key levels before you enter your first trade. So all that is important for you to figure out as far as using the daily key level strategy of taking trades off, either bullish or bearish trades off of any of the main key levels, and then using the QL levels or for tight stop losses, or the midpoint levels for your standard stop losses, and then also the process of managing your trades, of level to level management of trades moving one level in your favor for scalp trades, or 1.5 level move or greater for regular trades. So those are the two different types of trades taken with this particular indicator. Scalp trades being a one level move in your favor, and then regular trades being a 1.5 level minimum threshold move in your favor, for then having the options available to you to either adjust your stop loss to break even, or break even plus a profit buffer. And then if you also, or do you prefer to just exit your trades, your regular trades, 100% at the minimum 1.5 level threshold, or the 2 level ideal move threshold? And then thirdly, if you're the type of trader who's trading multiple contracts, say 3 or more contracts, do you prefer the method of scaling out with regular trades at the 1.5 level minimum move threshold, by selling 70 to 90% and exiting 70 to 90%, and then holding on to runners and adjusting your stop loss to break even, or break even plus a profit buffer on those runners, and then managing those runners through additional waypoints of a 2 level move, a 2.5 level move, a 3 level move, and above for managing runners. So all of that is important for you to figure out for yourself as far as utilizing this indicator for your particular process during that, say, 25 to 35 practice sessions or so. So again, that's just a general guideline, 25 to 35 sessions. That's assuming that you have a decent amount of experience, say at least light to moderate experience. If you have virtually no experience or no experience, then you would probably need more sessions than that. And if you have a great deal of experience, then you would probably need less sessions than that. But the point being is that when you're getting used to using a new indicator, you want to get proficient at using it on a demo account. And then once you feel you're proficient at using it and you have your process figured out of how you prefer to use it, then switch, at that time, consider switching to a regular live real money trading account. Okay, so I hope this video has been helpful. If you have any additional questions, you can send us an email at daytradinggps@gmail.com. Thank you.